SAP, another company that kind of came out a little bit soft. Now, SAP is interesting, Pat, because they report overseas, and you and I get the message sometime in the middle of the night. And I do sleep at night. People sometimes wonder if that's true. I do. I woke up, I looked at the number. I think the kind of the whisper number or the whisper versus, Pat, we look at those guys and say miss. It had a lot of misses. I think it had like almost all, but they were all really close. And I think that was one of the things where Wall Street's just very punitive. And so there is no close. There is no 99%. You either hit the number or you don't hit the number. And that's kind of how the market looks at it. So when you look at share price, you got to keep that in mind. But when you look at actual performance, you got to kind of look back and say, in most classes, including the hardest AP classes on the planet and the hardest collegiate classes you'll ever take, a 99 is still an A. So there's an argument to be made that what SAP did was pretty good. Now, over the last several quarters, Pat, and I'll tell you, SAP numbers are harder to parse than a lot. I find them hard. So let me tell you where I look. And where I tend to look are in a couple of places right now. There's the logical growth, revenue and profit. And of course, you're kind of looking at how is that? Well, 11% up, 5% at constant currency, gross profit up 10%, 4% at constant currency. So again, growing over what was considered to be good growth during stronger economic periods of time. They kind of do this thing where they put cloud and software together and then they parse cloud out. The software is kind of the older part of their business, but the cloud part of their business, and you and I have had a chance to talk to Christian Klein, this is the part of the business that I think investors and market and people that are kind of evaluating SAP really need to pay attention to. Cloud revenue growth, Pat, 33%. You know who grew less than 33% in the cloud? Microsoft. That's what I'm saying, and I'm not trying to be critical of Microsoft because 31 was good, but I'm saying 33%, $12 billion number in, and I believe, by the way, are these euros? I sometimes get torn. I think they're euros, but 12 billion.
Definitely not Deutschmarks.
In the cloud, and that's a 33% growth number with a 27% growth number to their cloud backlog, Pat. Yeah. So when I'm looking at these numbers, I'm saying, they're kind of growing in the right places. Now, what probably irked some people, and by the way, longer term will probably drive the share prices up, is they also announced some restructuring. Now, some companies are calling them RIFs. SAP is very clear that this isn't a RIF. This is a strategic restructuring of the business, meaning they want to put more resources and spend more dollars on things that are going to pump up their growth numbers. And if their growth is coming in the cloud, then they're making somewhat of a rotation. They're getting kind of cutting back on some areas that have maybe become lagging or slowing parts of the business to put more dollars to use into these other areas. So that's going to be something that people were kind of debating on whether it was a good or bad. Pat, I across the board, and this is something, you had a great piece. We did this on the show last week about RIFs and the meanings of them. I hate any individual being hurt. And when you look at these at a micro level, you have to be inhumane to not care about people losing their jobs. But when you back off of companies that are hiring hundreds of thousands of people, it's not equilibrium of performance across the organization. It's not equilibrium of talent and skills. Companies that make decisions to try to care for everybody oftentimes, the few oftentimes really harm the everybody of an organization. So if you have to cut 3% of your workforce to reinvest in a different skill, a different talent, to be able to make sure that other 97% have jobs in the long run, are able to continue to grow in their careers, that's a decision that had to be made. By the way, Pat, that used to be done regardless of economies. Companies used to just cut 1, 2, 3, 4, 5% of their workforce every year because they needed to get the lowest performers out and bring the high performers in. There was a time when I don't think that was scrutinized. There was books written about it, about what a great strategy that is. Somewhere in between lies the truth. Last number that I think we pay attention to, and that's the share of more predictable revenue. Almost 80% of what SAP does is predictable. At the size and scale and scope they are, that's pretty damn good. When 80% or so of your revenue, Oracle has a similar number. That's a really nice, predictable way. Now, the things you got to criticize, the earnings per share are way down. Operating profits are falling. This is what they're dealing with the restructuring. I think we give them a couple of quarters to come back, but we want to watch that cloud growth. That's the long-term health of SAP.
Good analysis, Dan. I don't understand why the market is reacting like it is. That's one reason why I'm an industry analyst, not an equities analyst. I mean, if I look at Oracle, ServiceNow, Microsoft, and Adobe, all up over 5 days, you've got SAP that's down 2%. And with that cloud growth looking really good, I did talk to a few people that said that some of the financial analysts had used a currency conversion that was there 3 months ago. And so it's just a complete confusing mess to me. So what I need to do is I need to go back and look at the company kind of holistically and its value propositions. If you noticed, they spent, you still there, Dan?
Yep.
If you notice, they spent most of their time spending about 20 the entire year. In fact, it was hard for me to find what they actually did just in the quarter. And I kind of had to go back and look at their website in real time. I mean, it was hard to figure out actually what happened. One of the biggest announcement was that they said they were going to divest itself of Qualtrics. And maybe that had to do with the funny stock price right now, given how much SaaS companies are getting hammered. Maybe that's what's going on. But their operating expenses will go down, and that should be good. And then when you tie this with the rebalancing of the workforce or the layoffs, that should be good for the stock. But I'm really interested to see what the company is going to do with the cash that they get. Are they going to make smaller acquisitions? Are they going to, what are they going to do with it? Are they going to give it back as dividends? What I'd love for them to do is double down in what they're doing is investing in these small companies, these small cap, even startup companies, kind of like an innovation fund out there. So 33% cloud revenue improvement over the year, 27% increase in the backlog for cloud over 2022. And a pretty good fourth quarter, all said.
Yeah, I do want to throw in one comment. When you labeled off the other companies that were up for the week, and I obviously do a little bit of work with ServiceNow, so I want to disclose that. But that company beat and raised across the board. It beat on earnings. So, frankly, I think companies that accomplish that probably have a warrant justification to go up. But by the way, that hasn't been consistent. But that was one that I just noticed, like they actually did beat and raise despite this macro condition.
How about Oracle, Microsoft, and Adobe?
What's that? Those don't make sense. That's why I said like the others.
Adobe.
Your others were right on. Those two didn't make as much sense to me. Adobe didn't report, so they're just getting they're just some sort of indirect impact. But obviously, so ServiceNow just had a really good quarter, so that hopefully would be the driver. Even though their PE ratio is like 400. I'm not kidding, it's huge.